Business Weekly, brought to you by National Social Security Fund. NSSF, we secure your future.
On this week's edition of KTN Business Weekly, we look at the bittersweet story of the sugar industry in Kenya. We also talk to Chief Executive Officer and Managing Director at Mumias Sugar Company, that's Peter Kibati. That's on the executive wing. Remember that you can send your questions, observations or comments to 8041 or the email address ktnbizweekly@standardmedia.co.ke. Good evening and welcome to this edition of KTN Business Weekly. I'm Michael Oyer. With a final extension of safeguards from COMESA, the Kenya sugar industry is fast approaching its tipping point. In less than 2 years, the industry will be required to face head-on competition from other sugar-producing countries in the region. In their current form, sugar millers will fall by the wayside. Tonight, we assess the state of preparedness by local millers and whether they're ready to take on competition.
Sugarcane farming to many households in western part of the country is a way of life. To the Kenyan economy, it's a key contributor to the gross domestic product. The subsector accounts for about 15% of the agricultural GDP, and it's also one of the dominant employers. However, over the years, the pride and status of the noble venture has continued to dwindle, right from the farming household, right across the government policies on its management. The spotlight has in the years constantly shifted from the government to millers and farmers, in the wake of it causing confusion on who in the chain holds the key to turn around the situation.
Kenya doesn't have a single agriculture law, so what we have is laws that govern sectors. And in the sugar industry, of course, it's the laws that deal with the sugar industry and sugar act, which is on one side established the sugar authority or the board, and then at the same time, of course, establishes regulations and rules that govern each of the, or rather, governs the sugar industry in Kenya.
Cane production should be a scale activity. So the bigger the scale, the lower the cost of production. Then when you look at what's happening in the rural areas, land subdivisions are serious. So you find now the land sizes that we had 10 years ago, right now we may be having about half those sizes. So what that means is that the cost per unit of producing cane is also up.
In these modern times, both the urban and rural economies are judged by the investment they make in education, science and technology, culture and innovation. Information, particularly scientifically valid information, is critical for turning the ever-increasingly complex challenges society faces in opportunities for more and better sustainable development. But when information is hardly available for sugar farmers for all these decades, then there is something amiss.
COMESA is a legal obligation that our government bears. So it is not as if somebody forced it on us. I think we need to clarify that. So if you're going to be members of COMESA, and we have certain gains in COMESA in the sense that we also export certain products, then we must also anticipate that we may have to import others.
It's ridiculous that even the government considering levying a tax on a raw product like food. So if that's where we want to go, definitely it will be expensive. Otherwise it will be cheap if the industry is subsidized, and that should be to the benefit of the consumer.
In this regard, sugarcane farmers have continued to play their trade only with the knowledge of hindsight. These has seen them miss out on crucial farming trends and methods key to improving their yields. In a nutshell, the supply of seed cane is wanting, extension services is privileged, while in some instances, sugar dealers have been accused of outright buyers in dealing with farmers, those who have contracted and those who have freelance.
If we look at the roads that we use to transport cane, because cane, is a field-based operation. Now the roads that we use to transport cane into the factory, those roads are in a terrible shape. So the wear and tear of our equipment is high. Cane spillage is also very high.
all our factories put together do not produce enough sugar to meet demand, which means Kenya has to import some more. And the import is regulated by the regulatory institution for the industry, which also operates the Sugar Authority, which also operates as an interest group for farmers, but at the same time as an institution that imports sugar, which puts it in a conflict of interest in my view, because then who guards the interest of consumers?
Currently, the production in the country does not meet the local demand for sugar, thus creating a shortfall which can be filled through utilization of idle capacity and additional sugar factories. Kenya's population grew at an average rate of about 3%, while sugar consumption is estimated to grow at an annual rate of 2%. Kenya's membership in the regional trading blocs such as COMESA, African Union, and the East African Community provide potential investors with a large potential market for their products. As a member of the COMESA Free Trade Area, Kenya is allocated duty-free export of sugar to other COMESA Free Trade Area countries. Kenya also has an export quota for sugar to the European Union. This offers potential investors with a ready and accessible market for their white sugar. However, the inefficiencies of the sector have seen the country rely on import to meet the shortfall that currently stand at about 300,000 metric tons, as it can only produce 500,000 metric tons of white sugar. With the expiry of the COMESA safeguard fast approaching, most sugar processors are not sure if they can compete favorably with the cheaper sugar from the region.
The COMESA market has to do with efficiency, and if it's a question of efficiency in the sugar industry, one would say practically the private sector of the industry has taken over. We have new investors who are private, they are more efficient, and also the state sector, is also really increasingly efficient.
Under COMESA, there are regulations and rules that govern how the trade in the industry takes place, especially the trade in movement, imports and exports of sugar. And it did establish certain quotas which allow for the minimum imports, but at the same time they allow for a government such as ours to establish rules and quotas, regulations for imports and quotas that allows us to import a given minimum of sugar from COMESA Industries, a partner country.
As a matter of urgency that was seen as a way of the government trying to save these companies from collapse with the entry of the cheap sugar, the government through the Privatization Commission appointed transaction advisors to work out the final details for the privatization of all public-owned factories. Alongside the privatization, the government was to initiate a program for financial restructuring of all public factories. This will be in addition to the continued government support in the development of essential infrastructure such as roads, irrigation, as well as a basic research and extension, all to boost the competitiveness of local players.
I think there is collective pressure on the part of all industries, sugar industries in Kenya, for government not to allow in imported sugar because then that would, for some of them, they would lose market share.
The 2010-2012 Kenya Sugar Industry Strategic Plan is intended to be the basis of facilitating the transitional requirement in the sugar subsector. It sets out the framework that will enable the industry achieve its vision of being a world-class multi-product sugar industry in the next 5 years. Despite the challenges the industry faces, the plan underlines the industry commitment of being efficient, diversified, and globally competitive.
In the perspective of the consumer, COMESA is good. Yes, there will be more sugar in the economy, and in the event that that translates to some kind of surplus, then it will depress the prices for the benefit of the consumer.
Kenya's sugar industry has been held back by high production costs and a lack of credit for input, leading to low yields and an annual national sugar deficit. The high cost of production is linked to poor roads in the cane growing zones, as well as aging factory machinery.
The ultimate winner, in my view, right from the beginning, once the liberalization takes place, will be the consumer, because our prices, the consumer's prices are almost guaranteed to go down unless we introduce further tariffs and hidden taxes.
Unlike other food products, sugar is highly taxed in Kenya, and players are calling upon the government to review its taxation on sugar, especially excise duty and VAT.
Time for a break now, but when we return, Peter Kibati, the new Chief Executive Officer and Managing Director at Mumias Sugar, is our guest on the Executive Wing. Stay with KTN Business Weekly. Welcome back. Mumias Sugar Company currently controls nearly half of the sugar market in the country. As a listed company, the firm has continued to set standards in the local sugar milling industry. Tonight, Peter Kibati, who was recently appointed the head of the firm, is our guest on the Executive Wing, sharing insights of where he wants to take the company.
Joining us this evening on this edition of the Business Weekly is Mr. Peter Kibati. Mr. Kibati was recently appointed as the Chief Executive Officer and MD Mumias Sugar Company, the leading sugar miller in this country. He joins us this evening to explain to us some of the issues facing the industry, as well as tell us how he plans to take forward the company. Karibu sana, Mr. Kibati. To begin with, where do you want to take Mumias in the coming days?
Well, Mumias Sugar Company has been on a growth path over the last 40 years. It started in 1973. Whereby basically it was set up as a way of reducing the amount of sugar that was being imported into the country. And the company started off producing about 80,000 tons of sugar per annum. And over the years we expanded to 300,000 tons of sugar per annum, which is now our installed capacity. So now we've moved from that stage where it was previously a government parastatal. It was privatized in 2001, and now the government sharing is 20%. It's now publicly listed on Nairobi Stock Exchange. So I think now it's one of the blue chip companies, and we want to move it now from strength to strength over the coming years.
In this side of the region, Mumias is referred to as the market leader or the tiger of the industry. Probably could share with us some of the issues that you still want to do in terms of expansion, going to across borders, the East African community, and probably, if possible, the COMESA region.
Yes, we are the market leader, but it's easy getting to the top. The problem is staying there. So obviously we have to ensure that we do maintain our market position and see how in terms we can improve in terms of our productivity and in terms of our efficiency. So the byproducts we're going into is not just purely for survival. It is actually one of the conditions that was given in the safeguard measures, that in terms of being competitive, you need to be able to diversify into various products. And obviously, because the margins tend to be higher on those new products, obviously then it helps to improve the profitability. So we're able to give that back to the shareholders, to the farmers, and all other stakeholders.
Rightly, you've mentioned the farmers, and they're the core to your business. How do you ensure that the farmers that Mumias has contracted to supply it with cane are content and satisfied with the business that they're doing with the company?
We do contract farmers, and right now we've contracted 104,000 farmers within that zone. So it does take care of quite a bit of the economy of that part of Western Kenya, because up to about 2.5 million people do depend on the sugarcane and also Mumias. So it's very important that the company is able to provide those facilities. We provide them on credit. So we do provide those facilities, and right now we've invested about 2.5 billion shillings in cane development for those 104,000 farmers whom we have contracted. We are trying as much as possible to provide them the best seed cane varieties that they require. We have established cane buying centers. We already have one in a place called Kisoko in Nambale, in Busia. And we are coming up with 2 other cane buying centers in Bumula and in Navakolo, so to bring services closer to the farmers.
Right now, the hot potato in the Western Kenya region is Busia. and Mumias is an interested party, both to the court case and to the interest of the farmers. Just share with us what is happening in Busia and how you plan to take it forward.
Busia is very, very important to us because it provides up to about 15% of the cane that we are crushing. So it's a very important area for us. It's got lots of potential in that area because you find the pieces of land tend to be bigger than what we have in the other areas, and we're in it for the long run.
Moving from the western region to the coastal region, and we get to Tada, in the Tana Riverbed. That is where Mumias wants to set shop next. Where are we? How much do you plan to invest? And in your assessment, what is the progress?
Well, so far we are still at the feasibility study, which we did, and it was shown that it's very, very viable. And it is one of the key projects in Vision 2030. In fact, it's supposed to be a short-term, one of the short-term objectives of that. So I think we're also under pressure to get it going. So we're very much interested in that. We were put back a little bit, some court cases which came in, and those have been handled. And it was ruled in our favor. So we've got the go-ahead now to progress. So it's a very good project in that it will complement what we have in Mumias. One, it is lowland, and so the cane matures within 10 to 12 months. Second, it will be large scale. It's about 20,000 hectares, of which 16,000 is a nuclear estate, which will be owned by the company, and 4,000 will be outgrowers. It will be under irrigation, which would be so they can control the conditions. So we expect that the cost of the cane will be around about maybe 60 or so % of what we incur in Mumias. So that's going to be able to reduce the cost of production, and also we'll make it a fully integrated sugar plant, producing both sugar, producing ethanol, and electricity from the onset. So obviously then we'll be able to get much more revenue in the short run.
Once again, thank you very much, Peter, for agreeing to host us. That was Peter Kibati, Managing Director and Chief Executive of Mumias Sugar Company, just sharing with us his insights on the sugar industry as well as how he plans to take forward Mumias Sugar Company. This edition of Business Weekly, Executive Wing.
In the money markets, the Kenya shilling is yet to gain a comfortable zone against the US dollar. It was quoted at an average of 84.23 at midweek session, while to the sterling pound traded at a mean of 131.98. Against the euro, the home unit exchanged at 103.64, while to the South African rand, the shilling continues to weaken, trading at 10.19. That's all we had time for in this week's edition of KTN Business Weekly. Remember that you can send in your comments or questions to the email address ktnbizweekly@standardmedia.co.ke or to the number 8041. From myself and the entire KTN Business Weekly team, thank you for watching. I'm Michael Oyer. Good night.
Business Weekly brought to you by National Social Security Fund. NSSF, we secure your future.